And we're in that sweet spot for gold and silver, more so physical gold and silver, simply because they're not connected to the stock market. So if we do see the stock market top and can continue to sell, gold and silver are disconnected. They can actually still keep moving higher. And that's what we've seen in the past in this stage 3 topping phase. They can buck the trend and rally 5, 8, 10, 15%, while the stock market potentially falls 5 or 8%. And the gold miners, because they're stocks and they're stuck in the stock market, when the stock market is kind of falling, yes, gold miners should be going up with gold and silver, but there's natural liquidation going on in the stock market. So it'll mute the move up in miners.
The commodities sector ended down 4% in July, with gold the notable exception amid increased rate cut focus. Lower funding costs for holding a position in a non-interest-paying metal, such as gold, will increase its attractiveness, and during July, we have seen some early signs that interest rate-sensitive investors have started to warm up to gold, with the total holdings across the major ETF showing the biggest monthly increase since March 2022, when total holdings peaked above 3,200 tons, only to suffer months of net selling amid rapid rising U.S. interest rates. ChrisVermeulen has over 25 years of experience in financial markets as a seasoned technical analyst, equities trader, and investment strategist. In the face of ongoing trends, ChrisVermeulen attributes the recent gold price pullback to panic selling amid stock market fears. Despite this, he remains confident in gold's long-term upside potential. Due to its reputation for being a safe haven asset, gold tends to perform well during a recession. For example, when the stock market collapsed in 2007, investment demand for gold spiked and continued to rise, and gold doubled in value between 2007 and 2011. From a technical standpoint, Vermeulen forecasts silver prices could reach up to $38 per ounce and emphasizes that physical gold and silver can rise independently of stock market declines. He advises prioritizing gold and silver investments over miners, who may be affected by stock market fluctuations. Regarding gold miners, Vermeulen suggests they could face sharp declines similar to the 2008 crisis. He anticipates gold prices could pull back to around $2,000 before a significant future rally beyond $3,500. Now, we present the clips of ChrisVermeulen's insights from his recent interview. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
I really like gold. I think gold, when we look at it from the super long point view, let's just go back to this is the weekly chart. So I like that we've got multiple bull flags. We have a rally here, a bull flag, and then it's rallied up. There's all kinds of different bull flags within here, but this is another really nice bull flag rallying from just a couple months ago. It is pointing to 2650, 2750 still. It did poke to new highs a week or so ago, and then it's pulled back a bit. But the pullback that we saw really has to do with what I just mentioned to you, Andy, which is when there is panic selling, when people are afraid, they dump everything. And so as in the last couple of weeks, we've seen the VIX shoot up. People have been scared because everybody piles into the Magnificent Seven. They all do the same thing. And when they crash, they all panic. And so there was panic in the stock market seen by the VIX. And as the VIX shoots up, we even saw the fear hit the gold market, pulled gold back. And so that's the problem and that's the problem with the bear market is even a good asset like gold, when there is panic, people don't care. When you're scared, you run. Yep. And so that's what that is. I think this pullback in gold is just kind of shaking things up. I do think gold has still got really nice upside potential. I think silver on the weekly chart as well has a very nice upside. I think silver could be $36 or $38 an ounce going forward. This has got a beautiful run to the upside. It's got a beautiful bull flag. It's flagging in the opposite direction of the trend. So the trend here was up, and then it should continue up to $36, $38 per ounce. You know, if this panic selling dissipates and then we see that next leg up, and we're in that sweet spot for gold and silver, more so physical gold and silver, simply because they're not connected to the stock market. So if we do see the stock market top and continue to sell, gold and silver are disconnected. They can actually still keep moving higher. And that's what we've seen in the past in this stage 3 topping phase. They can buck the trend and rally 5, 8, 10, 15%, while the stock market potentially falls 5 or 8%. And the gold miners, because they're stocks and they're stuck in the stock market, when the stock market is kind of falling, yes, gold miners should be going up with gold and silver, but there's natural liquidation going on in the stock market. So it'll mute the move up in miners. And I've been trying to let people know, like, I think the safest, lowest risk play, I think, is gold. And then I think silver. And then you've got miners, just because miners are stuck in that basket of the stock market. If it crashes, it's going to naturally want to pull the miners down with it. You could argue we're kind of in this phase and like potentially right here on gold miners where we are right now. They could potentially like go into, this is 2008. This is the 2008 crisis where it sold off and broke down. If we kind of look over here at gold miners, I'll just clear this chart a bit. And this is a much larger pattern, but we definitely have this potential push high right here. And we could very easily see this pullback with the next major reset. Here was the COVID crash. You can see how much they crashed. This was the 2008 financial crisis. So they could get hit very, very hard coming back. But just to go back to gold, Andy, real quick, the monthly chart is a really nice view of where we stand in the big picture for gold. And I like gold because if we look at it compared to what we've seen during the other bull and bear market phases, we saw gold more or less break into a new bull market in early 2000s, had a multi-year consolidation. And then we saw a big run up just before the stock market sold off and started the 2008 bear market. Well, we started a new bull market in 2019 for gold. We've had a multi-year consolidation, and now it's running up because people see, I think, music coming to an end. They're fearful. So this run up right here, just before the state or bear market, is, I believe, where we are right now. I think gold can still push quite a bit higher. This is a very big bull flag pattern pointing to 2650, 2750. And then what people need to realize is when we enter a bear market, we could very easily see gold potentially pull back even to the 2000 level, 2000 per ounce, very similar to 2008. Gold pulled back 34%. And it's not a bad thing. It's just the way the markets move. And then after that, once it does bottom, we should have that second half of that move. And that's where I think we're going to see 3,500 plus in gold and potentially way beyond that.
ChrisVermeulen anticipates that the recent surge in small cap stocks, fueled by factors like tax cuts and shifting investment trends, may be temporary. He predicts that the Russell 2000 could soon reach a peak and face a sharp decline, echoing patterns seen in past market tops. The broader S&P 500 tumbled 1.5%, and the tech-heavy NASDAQ composite dropped a stunning 2.5%. It's been a turbulent few weeks for markets, as some earnings reports have been underwhelmed, and fear about increased tech regulation and lackluster AI performance have soured investors' moods. Consequently, Vermeulen advises monitoring the market closely over the next few weeks for signs of a potential downturn. He advises investors to remain cautious amid the current market turmoil, characterized by money shifting between large cap and small cap. Let's get back to the interview.
I think this more recent pop is more so like, Trump's talking about tax cuts and all that stuff, which generally helps small businesses. We've seen it. We saw this when Trump got in originally many years ago. We saw stocks want to take off because of tax benefits. Also, money is flowing. It's rotating out of large caps and it's trying to go somewhere else. And so if Trump is likely to win, and if everybody's fallen off the radar, then there's conviction. When people know what's going on, they're more confident. So that could create money to go into the small caps. It's got the tax benefit. Money's rotating out of the large cap. Now it's got to go somewhere else. So people are moving into the small cap stocks. And we're talking about interest rates potentially, have topped and maybe we start to see a quarter basis point cut. And that's bullish on the stock market as well. Now, overall, like when we look at the level here of the Russell 2000, just draw a line across here. I mean, it really is struggling through this top that we saw in 2021. We've actually seen this type of price action, like where we see the Russell 2000 hold its ground and then it has a quick squeeze up and then it sells off very dramatically. It's been kind of doing a very similar type of price action right now, squeezing up. And what this is a lot of times people become really bullish on aggressive stocks just before they top. And so I have a feeling we could actually see this market top out very soon, within like a week or two, and this could roll over. And if we were to go back and take a look at the weekly chart of the Russell 2000, and we go back to the 2008 market top, we had a very similar type of price action, which though you can see this upper wick where price consolidates and then small caps become in favor, everybody piles in, and then they dump out and sell off. And so we saw this before. This was the 2008 market top and it broke down. So we fast forward to today, we have a very similar type of price action where we've got this breakdown. We've kind of have this price consolidating and now it's squeezing up. And I think we're going to potentially break down. So the next few weeks, I think are going to be very critical. Does the stock market, do the Magnificent Seven recover, or is it kind of lights out and now things are about to run out of speed and the small cap stocks are getting the love right now, but it's going to be very short lived. So that's what we're looking for, looking to see what unfolds there. I think the key for everybody to understand is there's a lot of turmoil in the markets right now. We're seeing money just slosh around from large caps to small caps, from risky stocks to utilities. Like utility stocks are holding very well. Right now, we're definitely in a turmoil. So if I give anybody advice, I'd be like, just kind of step aside and let's just see what happens over the next 2 months. And we're going to get an idea probably over the next few weeks or a month or two of like, is a trend going to start going higher again in the stock market, or is it actually going to create a bearish pattern and then start to break down another leg potentially in a few weeks or a couple of months. So I wouldn't expect anything huge. I think you just need to be, we're in that summer doldrums. It's naturally a weak time for the stock market and we're seeing weakness and we're just seeing chaos. So don't expect much. Go enjoy summer, I would say, and liquidate some of your positions in terms of equities, because I think they carry a lot of risk here.
Gold's true value often shines brightest when the market's fears dim its luster. Gold has staged a remarkable rally, posting solid gains for 3 consecutive days, driven by a complex interplay of economic indicators and global events. Heading into the weekend, the price of gold fell below $2,500 as investors were forced to raise capital. We could continue to see lower prices in the near term. However, in this environment, the precious metal is ripe for higher prices in the long term. Given the current market dynamics and expected interest rate changes, how do you perceive the future potential of gold in your investment portfolio? Drop your thoughts in the comments section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.